Well, an interesting morning is developing just before I was getting ready to go live. The market fell apart and everything trended down rapidly for a few minutes. And now it seems to be correcting. We're talking about all of this in just the last 5 minutes. But then that's the fun part about the stock market, right? For a minute there, we were down within 8.5 points of getting to my 265. Tesla's right now sitting at 254.37, having recovered a little bit after it, like I said, fell off a cliff. It was at 266.50 just a few minutes ago, seems to be heading back up again. Anyway, whatever the case may be, we're getting closer and closer to the 265 number. And we still have, what, uh, 16 days and 12 trading days to go before we get to 1010. So, anything can happen. Some folks are now suggesting that maybe Tesla could get to 300 by 1010. Don't count me in that group. I'm going to be very happy with 265. And then, of course, the big question is what happens after 1010. And of course, we've had many conversations about that here on the channel. Maybe I'll discuss it again before we get done today, but maybe I'll hold it for conversations later today with the likes of Nicholas Gibbs. I'm sure he'll have a comment or two about that. Well, why is Tesla going up so much? Well, of course, it is 1010, but then there's also the China numbers. The run rate at Shanghai is one vehicle for every 30 seconds right now. So that's the normal day in and day out run rate. We heard some earlier comments that we were under 30 seconds. Maybe that is a burst rate, but 30 seconds now is the current run rate. By the way, that turns out to be almost exactly 1 million per year when you do the math. Now, most would think that you can only count about 80% of that on an ongoing basis. You got downtime, holidays, all kinds of things that get in the way of getting 100% of your capacity. But right now, 80% of that would be 800,000 a year. The reality is we're starting to see that we're getting pretty close to that million run rate on a regular basis. So maybe at least in the third and fourth quarter, we can figure that we're pretty darn close and can figure for 250,000 or roughly out of China. Well, what about this particular week? Well, Gary Black reports this morning they had a solid 13,800 insured registrations. That doesn't count what was exported to other countries. And that's with taking into consideration that they have a 2-day mid-autumn festival national holiday on the 16th and 17th, which might have impacted it. Through 12 weeks, the third quarter is up 18.5% year over year and 19.9% quarter over quarter, remains on track to be Tesla's best China quarter ever. He also notes that China has put in some more general economic stimulus. This is probably also helping the stock. They're currently selling 100% of production. What happens when additional margins comes? What happens when FSD gets to level 5? What happens when FSD becomes available in China? Because remember, they can sell it in China, but people can't turn it on yet. What happens when that happens? What happens to sales? It seems to me like we are under capacitized. Is that a word? We don't have enough capacity in China to take into consideration increased business that's going to be coming. We talk about increased business in the other countries as well that China serves, like Australia and Great Britain and South Africa. You just go around the world, all these different places. Apparently, they're getting ready to go into the Philippines, potentially getting ready to go into other South American countries. Where's it going to come from? We could be getting into a real serious capacity problem. Now, maybe that's being addressed. We know that they're making some additional changes over there in Shanghai, but it would seem like you need a whole nother building or, at least a lot more space. Don't know. We'll be figuring that out. Oh, yeah, not to mention making Gen 2.5 and or making robotaxis, cybercabs. Anyway, we'll see what happens. Maybe we'll get more information on 1010. This from Sawyer Merrick today. He says Elon Musk met with various world leaders today in New York because the United Nations General Assembly is having their big to-do where the president of the United States will be speaking. That could be not so good. Maybe that's why the stock market just crashed. I'm not sure. Anyway, the Italian prime minister, who Elon seems to be more than casually interested in, was one of the people he met with. The president of South Africa, the president of Argentina, and I believe one other South American country as well. Elon has met with more world leaders than some world leaders, like the president of our country. And Sawyer says maybe once the maybe we should decide who should be our leader based on the number of world leaders that are being met with. Anyway, silly stuff. All right. This is from a PR newswire this morning out of Los Angeles. After what is likely the most extensive real-world test of Tesla's FSD ever conducted by an independent third party, this is according to themselves, covering more than 1,000 miles. 1,000 miles, that's kind of a small number. Anyway, AMCI's testing result demonstrates just how far Tesla must go before robotaxi operations can be safely undertaken. AMCI's testing evaluation was based exclusively on Tesla software iterations 12.5.1 and 12.5.3, with time spent across 4 distinct driving environments: city, streets, rural 2-lane highways, mountain roads, and freeways. While impressive, it says, for a uniquely camera-based system, AMCI, their testing evaluation of Tesla's FSD exposed how often human intervention was required for safe operation. In fact, our drivers had to intervene over 75 times during the evaluation, an average of once every 13 miles. Well, comments that came from this on X suggested that this is about right for a nervous driver like me. So 13 miles, it's about 16 miles to church, and I think I intervene not every trip, but on some trips. I don't know. I haven't asked my wife recently. She goes 6 miles each way, so that would be 1 intervention per day. If you're a nervous driver and I think that's about right. I think it's probably a lot better than that for folks that are not quite as nervous. And so it'd be interesting to see more testing, another few thousand miles maybe. Anyway, the comments also included that the real story is here that there's only an intervention every 13 miles or every 25 minutes or so. It doesn't seem like it'll take much to get us to significant improvement. And nothing in the article, not one word in the article, suggested the need for LiDAR or radar to get to the right result. The main suggestion was maybe it just takes more compute, more iterations, more content. This is Randy Kirk. If you haven't hit the like button yet, this is a good time. Subscribe and notify. And today we've got Brian White, part 2 coming up, the other 5 questions on my list of things I'd love to ask Elon if I had a chance. And yesterday's 5, I think, were well received. And the 5 today are pretty good too. And then tonight, Nicholas Gibbs, of course, will be joining us. Make sure to hang out with Nicholas, because he's always got some very cool and interesting analyses to provide us. And then joining Patreon, that's what you should do. Just go down and do it. All right. The S&P CoreLogic Shiller 20-day house price index rose, 0.3% in July compared to the previous month. Home prices in the 20 major U.S. metro markets were up 5.9% over the last 12 months. That's a slight deceleration compared to the 6.5 the previous months. Economists surveyed by the Dow Jones Newswire and Wall Street Journal had expected 6%, so they came in pretty dang close. Okay, so not terribly unexpected. I would expect to see this number continue to be up, all the way through the end of next year. I don't see any chance that there's anything that could happen. I mean, sure, you could have World War III. I mean, there's lots of weird, but under normal circumstances, if there's no major black swan events, houses are going to go up 6% again next year, okay? And maybe more as mortgage rates come down. A broader measure of home prices, the national index rose 0.2% in July and was also up 5% over the past year. All numbers are seasonally adjusted. The 20-city and the national index are at an all-time high. Duh. You can also be forgiven. So, the next article, please. I know it's going to sound extremely familiar, but that's kind of why I'm going to enjoy telling you about it, because here's somebody that just seems to agree with me exactly. I mean, exactly. This is from Business Insider. According to Anna Wong, the Bloomberg economics chief, their chief U.S. economist, not some lowly economist. She is it. She's at the top of the heap. She says there's a 70% chance that the U.S. economy is either already in recession or headed towards one in the months ahead. While that might be strange to hear for the majority of investors who see a soft landing coming, the biggest indication for Wong is the downturn in employment indicators. Now, that's slightly different than me. My biggest indicator is that the consumer's out of money, but don't worry, she'll get to that. The one that stands out most to Wong is the much talked about ROM rule, measuring the change in the rate's 3-month moving average, which is now at 0.57. Anything over 0.5 is a recession threshold. Wong believes that the 0.5 level is actually conservative, and that any mark over 0.33 is just as accurate in identifying a downturn. Well, that's really big. Holy mackerel, if they changed the ROM rule to 0.33, that would be significant. Also pertinent to Wong's downcast view are the more under-the-radar employment flows data, or the number of people going into or coming out of various states of employment. A rising number of people heading into unemployment isn't necessarily the problem if they can quickly find another job. But hiring is slow right now, with job openings and hiring intentions falling. We've been talking about that for days. This is causing a growing number of unemployed people to stay unemployed, a pattern seen in past recessions. Wong said that this can set off a vicious cycle. This is what I've been saying, that fuels a further rise in unemployment rate, and is why she said it would be unheard of for the Fed to keep the unemployment rate at 4.4 or lower. It's going to go up, she feels. Initially, in all recessions, this is how the unemployment rate tends to rise. The next stage is, well, firms' revenues are down, the attrition rate is down, and they have to resort to layoffs, and that usually happens 2 quarters into a recession. So the recession started June 1, in my opinion. 2 quarters would mean that we won't see the layoffs from this recession, the major layoffs, until the end of the year. Then those layoffs will happen, in my opinion. This is not her opinion. Then those layoffs will happen, and it will have a pretty rough 90 to 120 days. And then that'll bottom out, and people will start to pick up again as interest rates start to have impact. Not just interest rates, just the general cycle. Another key metric economists watch to judge whether the economy is in recession is, here we go, consumer spending, which makes up 2/3 of the GDP in the U.S. While spending is still strong in terms of headline numbers, Wong is skeptical about the health of the overall consumer and how long the spending boom can last. With the monthly savings rate at 2.9%, one of the lowest levels since the Great Recession, Wong said that spending has to be coming from 2 things. For the wealthiest 20% of Americans, it's robust household balance sheets that have gotten a boost over the past years from housing prices and record highs in the stock market. For poor Americans, it's credit card debt. Again, this is what I've been saying. 2 economies. People with over 100, 125,000 in earnings, they're doing fine. They're probably even doing okay in terms of their earnings, and they're probably still saving and putting money into their 401ks, but they've also come out smelling like a rose from the stock market and from the housing market. So the Bidenomics has really helped the rich. But the other half of the world, more than half, the folks under 100, 125,000 in earnings who don't own a house and don't have stocks, they're getting crushed. The top 20% indeed have benefited most from the housing and stock market gains. Here's the change Oh, it's a chart. Okay. Credit card debt is also skyrocketed, as shown in the lending tree chart. According to Fed data, delinquencies on credit card have increased almost 100% since Q1 of 2022. Wong believes wealthier Americans are spending due to wealth effect, where high asset prices boost consumer confidence and fuel spending. But if stocks undergo a correction, it could drive a reversal in this spending, slowing economic growth. And I'm telling you, we're going to have a 10 to 20% correction soon. Will it impact Tesla? Maybe. Depends on what happens with the new product introduction 16 days from today. I don't think we have tested the resiliency of the consumer, Wong said, and my guess is there could be an equity correction. Then we will see consumption drop off relatively quickly. Also pertinent to Wong's downcast view. Now, there was not going to be a correction in the housing market. I'm sorry, it's just not going to happen. Could be a slowdown. Sometimes people get scared even when things are perfectly ripe. And so you could see a couple of flat months in the housing market, maybe even down over the winter, which is the normal time. Also, so maybe January, February, that would be, that's probably going to happen. Also pertinent to her downcast view are that the under the radar employment flows data. Well, I already said that. I already said all that. Okay, breaking. Something happened. I duplicated. Consumer confidence number just came in. The Conference Board says that consumer confidence fell in September to 98.7, with 1985 being 100, from an upwardly revised 105.6. So it dropped from 105.6 to 98.7 in August. The Present Situation Index, based on consumers' assessment of their current business and labor market conditions, fell by 10.3 points to 124.3. The Expectations Index, based on consumers' short-term outlook for income, business, and labor market conditions, declined by 4.6 points to 81.7, but remained above 80. A reading below the threshold of 80 usually signals a recession ahead. A cutoff date for the consumer confidence dropped in September to near the bottom of a narrow range that has prevailed over the past 2 years, said Dana Peterson, chief economist of the Conference Board. September's decline was the largest since August of 2021, and all 5 components of the index deteriorated. Consumers' assessment of current business conditions turned negative, while views of the current labor market situation softened further. Consumers were also more pessimistic about future labor market and less positive about future business conditions. The drop in confidence was steepest for consumers aged 35 to 54. As a result, on a 6-month moving average, that group has become the least confident, while consumers under 35 remain the most confident because, when you're young. Anyway, confidence declined in September across most income groups, with consumers earning less than $50,000 experiencing the largest decrease in their confidence. On a 6-month moving average, consumers earning over $100,000 remained the most confident. Peterson added the deterioration across the index's main components likely reflected consumers' concerns about the labor market and reactions to fewer hours, slower payroll increases, fewer job openings. Even if the labor market remains quite healthy with low unemployment, few layoffs, and elevated wages, the proportion of consumers anticipating a recession over the next 12 months remained low, but there was a slight uptick in that. The share of consumers expecting higher interest rates over the next 12 months dropped. Of course, that would make sense. And then September write-in responses also indicated more mentions of interest rates as affecting consumers' view. Despite slower overall inflation and declines in some goods and prices, average 12-month inflation expectations increased to 5.2 in September. Nevertheless, this 5.2, that's a big increase. It was 3.5 or something like that. It was close to 3. Consumers' expectations for the stock market stabilized after the financial market tumbled of early August. 25% of consumers expected stock prices to fall over the year ahead. That's down from 26.5, while 47.6 expected stock markets to rise. Well, that's good. While still positive, consumer assessments of their family financial situation, current and expected over the next 6 months, weakened in September compared to August. Against this backdrop, consumer buying plans for big-ticket appliances were mixed. Well, that's good. Those planning to buy a smartphone or laptop in the next 6 months eased. However, a 6-month average purchasing plans for homes and new cars improved slightly. All right, and then finally, a new question about services. And this month's survey revealed consumers were still keen to travel and dine out in September. Found that consumers were still willing to stream entertainment at home, but the interest in going to the movies rose. Regardless, non-discretionary services like healthcare and utilities, planned spending over the next 6 months were also strong. So, yeah, there you go. Experience and healthcare. Yeah, the old folks got to have that healthcare, and everybody's all about experience. So, where are the markets now, given consumer confidence dropping? Was that what came out and caused the market to drop earlier? Well, maybe, and it's not stopped, and Tesla is now, yeah, it's everything is down. I think the consumer confidence thing might have knocked people for a loop, not expecting that big drop because it happened about that time. So what we got now is we've got Tesla up still $1.45, with the Dow Jones up still 33.81, NASDAQ down 63, and S&P 500 down 10.61. You've got all of the Magnificent Seven, except for Tesla, down now. That was not the case. Microsoft down 6, Meta down 7, Amazon down 3. I mean, we're talking about down, down, down. We have got the Cathie Woods, except for PayPal, and TDOC, but TDOC barely up. So basically, the Cathie Woods are all down also, except for PayPal, which is having a good week, along with Tesla. Tesla is now beginning to perk up a little bit, moving up a little bit from that 129, but still up, given the rough morning right now. Okay, let's go ahead and take a look at the percentages. I'm so sorry. Percentages is Dow 0.06 up, NASDAQ 0.42 down, S&P 0.22 down, Tesla up 0.52. Okay, let's go ahead and take a look at this bond situation. The bonds, okay, this is better. This morning, it was pretty rough here in the bond situation. It was up like another 4 basis points, but now U.S. 10-year is only up 1.5 basis points at 3.753. I'm thinking that the 3.75 level is going to be kind of the top. If it closes above 3.75, I'm going to be surprised. Okay, we have got the 2-year down 1.7 basis points. So broadening out that, or creating more and more reversion, if you will. And you've also got the 2-month and the 3-month both down. So everything operating right now as it should be, given the Fed's move and given all my expectations that we're already in or going into a recession. I believe it started June 1. You know that about me. I'm not sure that'll ever be proven. So I don't know how you'll ever be able to judge that. Okay, if you to the extent that you're judging me, maybe you're not judging me at all. Maybe some of you are just going, Randy, the analysis sounds reasonable and fair and interesting. I hope that's the bare minimum. Okay, oil right now up $1.28, $1.25 for Brent. So both about the same in terms of the dollar amount. I'm guessing maybe that has to do with Israel and what's going on over there. Maybe. We also have a hurricane hitting South Florida, but I don't think that's impacting. But it says China. China stimulus. That's what the headline is. Oh yeah. In fact, I should have just read the headline. Oil climbs on China stimulus, Middle East conflict, and hurricane risk. Honest. I read the headline after I gave you the analysis. Okay, so Texas Intermediate 71.58, Brent 75.13, natural gas finally taking a breather, down 0.61, but still at $2.59, almost $2.60. Okay, we've got gold up $9, another all-time high. Silver up 0.63% to 31.28, not an all-time high, but a recent probably high. Maybe not. I think it might have hit 32 a little while ago. Copper up another 3% this morning. This is one of the things that got my concern right now. We got to watch these commodities. Remind me to do a commodity analysis, a little broader commodity analysis. Copper is now at $4 and almost 48 cents. I'm thinking, and why would commodities be coming up unless unless the producers have already cut back on their supply because of their expectation of a recession? And, the difficulties in China, for instance. But China is doing this stimulus. So we'll see if this recent round, now they've done other stimulus recently, and it didn't seem to help. So will this new round of stimulus help? All right. The dollar is flat against the yen and up slightly, 0.351 against the euro. We have got the Bitcoin coming down this morning. Maybe that consumer confidence number impacting there, not sure. Back down to 62,825. That's down 543. And there you have it. That is the full range of what's going on right now. Going back again, Tesla continues to hold above the line, $1.03. All right. Let me know what you thought about this video this morning. I know it's just the same as I do every morning, but I got a lot of stuff right. And I think we're still going to hit 265. What do you think? 265? 300? What do you think? Maybe do you think we won't get to 265 in the next 12 trading days? And then hit the like, subscribe, notify, all that stuff. Hit Patreon if that is something that you feel encouraged to do this morning. That is in the description below. And then that's all I got for you. It's been great talking to you.